All right. Good morning, John Walkup.
Good morning, Noah Rosenblatt.
What a gorgeous day. What a gorgeous day for a little Macro Monday, huh? That's what I'm talking about.
It's great.
Stocks are up 3%. Sun is shining. Now, if we could just get May to do some things that May usually does, we'll be all right. Right, Johnny?
Yeah, I mean, look, the weather on Sunday was it was as perfect a day as you can get in the city. And I was all over the place. I was in Central Park, I was in Brooklyn, I was checking it all out. I mean, the city was
Beautiful.
abuzz, it was alive. And I'm really hoping that there was some solid traffic at some of the open houses out there. And some buyers were looking at a place. They're like, you know what, this just looks fantastic. And let's go for it. Let's go highest and best on Monday morning.
Boom. Yeah, hopefully that dopamine just hits the buyers right with their bids, right? That's how Sun translates to bids. I would love to hear some.
There was a guy I'll tell you this short story. There was a guy who was on my trading floor a long time ago who had a solid belief in the power of the sun, and he would take these. He would go larger, take these larger positions on bright sunny days because he thought buyers are willing to pay more for whatever stuff he was trying to sell on a sunny day. And sometimes it worked, sometimes it didn't. But hey,
whatever works for you. All right, guys, we're just messing around, but we're gonna get going. Okay, good morning, everybody. That is John Walkup. I am Noah Rosenblatt. We are both with UrbanDigs, and it is Monday, so you're gonna get a little Macro Monday coming right at you guys. For those of you that are new to this show, we're gonna start out with Manhattan real estate, take a look at what's going on, any changes that you need to know about, and then we're gonna go and look at those macro tabs I got going on over there. We'll try to end with Manhattan real estate and do all of this in 30 minutes or less. If you guys have any questions, there's a comment stream right to the right of YouTube Live. We will do our best to monitor that and bring some of those topics into the conversation, but that is where you ask any questions and talk amongst yourselves. Okay, give yourselves topics. All right, John, let's start with the ticker. Let's get an update on the weekly trends right here. I'm looking at supply 1,736, guys, for reference. In May, I know we're about midway through. In May, we're supposed to hit 1,544 in terms of deal activity.
Yeah.
On the higher side, because, April's a little higher and we usually dip down. So we're still a little bit above our monthly trend, but we're going that direction down. So it's possible that with the trend line guiding us that we end a month kind of a pace, like we're at in a pace level now, John.
Yeah, well, that's you look at what April did in terms of contract signed. It was all over the place in terms of this is a big week, a down week, all over, and it ended right on trend. So that's kind of what it's looking like right now.
Yeah, for supply.
For
supply, right. For deal activity, when I look at deal activity, contract signed, I do see a little dip, but you know what? It's got a couple of weekend days right over there. Those are the weekend days. You could always see weekend days. That'll filter out over the next 2 days. This will probably pop a little higher. When I look at some of these bars, I mean, we're still doing some decent contract activity, 59 deals in one day, 42. But when I go to the weekly trend, we're at 244. Okay, so the weekly trend is still down a little bit. If you look at this liquidity chart right at the bottom, I can't help but feel like this is, again, 2023. And now we're at that point where it looks like this has stopped falling, might bounce a little bit, but time will tell where it goes, John.
Yeah, it's really looking like 23, right? You got a peak, down, back up. So we've done that. We've done the first 2/3, right? We went up, we came back down. The question is, can we go back up again? I think we can. I think that we have another month left in the season, right? It's May 12th. Usually this will push through till about the week or so, a couple of weeks, maybe after Memorial Day, see some of those final contracts start rolling in before it starts, quieting off. So there's definitely a case to be made that we can go high. I don't know if we'll eclipse that high that we notched in March. That would be interesting if we did, but I think we have more room to run in the season left.
Yeah, that high, we hit a high of 1,168 early April before the tariff uncertainty. So now this whole tariff thing is potentially a pause. I'm wondering if this whole thing is being faded right now. You got a melt up going on in the stock market to a minor degree. How does this change perspectives? If anything, at the very least, uncertainty goes down. Same thing. It doesn't matter if the outcome is what you want or whatever. keeping politics out of it. It's like the election. Doesn't matter if the election went your way or not. Once it was over and they knew, decisions got made. And that's what it's about. If uncertainty goes down, decisions get made. And when certainty goes up, decisions get put on the side. So hopefully that little uncertain period that saw deal activity fall, again, for the sake of our spring season and May, I'm hoping that we have a good bounce back over the next 3 weeks or 4 weeks. Then you're kind of pushing it, I think.
Yeah. I mean, at the risk of jumping ahead, I mean, look, there was some news out, I guess, of the idea that China tariffs are going to be a lot lower than people expected. So I think while uncertainty remains, and I'm mainly talking about the Manhattan and Brooklyn real estate consumer right now. So while uncertainty sort of remains about the general direction of tariffs and the overall market, I think today's news has really sort of elevated the worst case scenario from like really bad to, okay, maybe it's not as bad as everyone feared. So I think that while that uncertainty remains, it's not as bad as we feared. And I think that's what you're seeing that in the stock market right now. And I hope you're seeing that in the real estate front as well. People, all right, let me make that call. All right, I'll bid another, $99,000 to get this deal done kind of thing.
Yeah. Yeah. Because that little fear and panic is not there anymore. It kind of subsides. So the emotions change. I wonder, when you think about a stock market rally and you think about a melt up type of a scenario, there's a couple of market dynamics that have to be in place to allow that to happen. One of them is nobody believes a rally. That's like one of those things. Like when nobody believes it, that's when it goes. You know what I'm saying? It's now when everybody's in it. Now when everybody's thinking the same thing, that's when it doesn't go, right? And a second thing is when a lot of people are short. They don't believe it. They take short positions. The rally keeps going. Now the short positions have to cover. They got to buy. That pushes more buying pressure. And that's how you get this melt up scenario. So it's a really interesting market dynamic. It's risk on for sure. And when we go to credit spreads, okay, guys, this is what I see with credit spreads right now. We had a nice move down. This is the uncertainty, guys, right there. When this was rising, that was the uncertainty rising. That's when our market paused. That's when the stock market puked. Okay. Once this stopped rising and started going back down, you see the recovery, guys. That's how this works. So now we kind of flatlined a little bit, right? It's like it stopped going down. You're like, all right, well, what the hell's going on here? And we woke up today with this news. So we're not going to get today's print on credit spread alert until tomorrow's print, right? Because the day's not over. You have to wait for the bond market to go. So I would think this is going lower in a substantial way right now, though, Johnny.
I would agree. I think we're probably ticking lower on the average of all of these little spreads that we track, but I don't think we're still below. I mean, maybe close, but we're not below the pre-Liberation Day levels. And you can kind of see, what is that, the 5-year, I suppose?
Yeah, let's start 5-year.
Yeah, you can see that spike, and we're definitely not back to where we were in February, March before these pressures sort of came in.
Yeah, we're kind of back to this whole period here. Let me see if I can make this a little thicker here. Hold on, so you guys see this whole period right here. Looks like we're back to that time period right there. I put the orange line in there so you guys can see where we're at. But the bottom line is credit spreads are coming in. This indicator is moving to the left. This is going on a downwards pace. Looking at today, this is going to continue, and that's good. That's good. That means the markets are risk on. That means credit stress is normalizing. It's going down after rising, right? And hopefully you guys now see, okay? Because this was doing a whole lot of nothing for a while, right? And we were talking on the show. There was like nothing to talk about. Now you guys see what can happen when credit spreads start to rise and the impact on the stock market and then the trickle-down impact on Manhattan. That's how it all ties together.
Well, and the other thing is, I mean, you can, the nice thing about having such recent history is it's very fresh. You can kind of remember those emotions. So you can see that spike. And that was a very worrisome time in the market, right? When the S&P was just, I mean, it was down multiple percentage points. It was going down 3 to 4% a day. It was,
you don't know when it's going to end, right?
Right. And you saw those credit spreads spike up. That's that pain. Now you just magnify for, the COVID was even higher and 2008 was even higher. So that's that sort of fear gauge. So luckily we've eased off, but we're not quite back to where we began, but go in the right direction.
Go in the right direction. Here's the max chart on credit spreads, guys. For those of you that are new to the show, this is kind of our guide to kind of, tell us which way we're kind of going. When this goes up, bad things happen. When this goes down, better things happen, good things, risk on. So again, it looks like we're going down. So that is a nice sign. Let's see if it lasts. Okay, let's see if it lasts. We're going to pivot. Okay, we're going to pivot to rates, guys. Rates section of the program. We go to FedWatch, CME Group. You guys could do this yourself. I am at the probabilities table. Let me see if I could I don't know if I can make this bigger, because I know you guys are, the bigger is better over here. We are, whoops, see, that screwed that up. We are here. Okay, guys. And there's been another change with rates from last week. If you notice, next two meetings, June and July, pause, no change now, right? The first rate cut, as the markets expect. When I say the markets, I'm talking Fed fund futures. This is basically the interest rate market, bond market, and what traders out there expect. 51% quarter point. Whoop, that's a quarter point. Okay, 1 quarter cut in September, and then one more in October. Boop, and that's it for the year. So you're now down to 2 cuts, which means if it was 2 weeks ago, it was 4 cuts. Last week, it was 3 cuts. And this week, it's 2 cuts, which, as you guys know by watching this show, that means mortgage rates probably ticked higher. And when I look at the chart, they did, John.
Right. So I mean, they're essentially going sideways. It's interesting to watch that jumbo, since those are the ones held to maturity. Typically, those will move a little bit sharper, and they have reacted to this, and they've moved sharply higher. Now, again, this is based on I think this is still Friday's data, so we're still waiting for what Monday's rates are going to be. But I mean, if you're out there and you're looking to get that mortgage today, you're looking at around 6 3/4 or so for a 30-year fixed, and you're looking at over 7 on the jumbo. So you're pretty much in very familiar territory. You're not down to where we were in March, certainly not where we were in September, October. So if you are a finance sensitive buyer, it's still like you're not having the best of times right now, because it's not going your direction.
Yeah, look at the spread between the two. Look at the spread between the jumbos, which is that light blue line, and the conforming, which is that dark line. What was your theory again on that spread when it widens like that?
When it widens, they're moving up. It's when they start going together, that's when you should start to see them ticking down. So the fact that they're widening suggests that they'll probably move higher.
Okay, I mean, so it's upward pressure.
I mean, the other thing is, and I don't know if we have a chart on this, but you can look at the moves today in the market, and the market's up. I mean, last I looked, it was like 2 3/4%. So the market's making a strong move up, but so is the 10-year yield, right? So if you think about where mortgages are priced off of, typically it's the 10-year yield. That's sharply higher over the last week or so. So in a nutshell, right, people are selling their bonds, which pushes the yield up, to buy the stocks. That's what risk on is. So as the money moves into the stock market and moves out of the bond market, that tends to push up these yields. So you're getting a little bit of resistance, in terms of like how much higher they can go, but that's going to filter through to mortgage rates, hence the spread. Hence, we might see these tick higher in the weeks to come, especially when you start looking at what the Fed fund futures are pricing in, and that's fewer cuts. Yeah,
this screams risk on. You're totally right. You go from bonds to equities. Screams credit spreads narrowing, right? Rates going up.
I just like quiet. I got enough with the horns and the ambulances and stop screaming.
Okay. It's a good tell. When the stock market gap up opens higher, when the stock market opens up 3% like it did this morning, typically it doesn't last. Typically by the time you close, it sells off. If you have a gap up open and we do not sell off and you end the market higher, that's just a big risk on sign. So we'll see if that happens today. I don't know if it's going to happen. All right, here's rates. They're on the high side of the range, guys. We're in a range. I still think we're in a range. We're in a range of like 6.5 to like 7.25 kind of thing. If you look to the left, 6.5 to 7.25. We've been in a range. I also got this chart from, I think it was Lisa Abramowitz, I think that Bloomberg reporter. She made the case that we're also in a range. I'm like, we talked about that on Macro Monday, how we're in a range. And she made this chart saying we've basically been in a range. Like if you take a step back and just take a look at mortgage rates, yes, they're moving, but we're basically in this range. She calls it 6 to 8% For us, we're in this like 6.5 to 7.25, and we're approaching the high side. So that's what you need to know for right now. We'll see whether or not it breaks the range on the upside. Okay. Any thoughts, John?
Well, I think the nice thing about being in a range, I think when you have mortgage rates that are stable, I think that's when you start to get some of the interesting loyalty programs and stuff out of banks. So I'm sure that, I hope there's some mortgage brokers on who could chime in the comments about what you've got going on, because it's when they become a little bit more predictable, then banks can start offering specials and entice people to take a loan kind of thing. So I'm a big fan of those. I think you really save a lot of money if you shop around. So
yeah. Okay.
Can I say?
Meanwhile, I thought this was interesting. I got a couple of things that I thought this was interesting on a housing level, not necessarily Manhattan, right? We're trying to make the show more macro, just step out of Manhattan for a little while. That's the difference of the show. Take a look at the green line, guys. Americans' assessment of the U.S. housing market. For people in general, do you think now is a good time or a bad time to buy a house? This is a Gallup poll. Gallup does a whole bunch of polls. The green line is those people that thought it's a good time to buy. It's going down. The orange line's going up. So again, I think the national housing market is in this, structural place that's a lot different than New York City. It's interesting to see this. I wonder what this chart would look like specifically for New York City. But I know in the housing market outside of us, there's a lot of buyers that probably feel like, now I'll just wait. You rent the market, whatever, right?
Yeah. Well, listen, I think one of the fascinating things about real estate is that just there's so many variables that go into it, right? And so you think about housing prices are a variable, mortgage rates are a variable, school districts are a variable, crime is a variable, right? Transportation, all of these things flood into this. So when you see a chart, is this a good time to buy? Is it a bad time to buy? Right. It really sort of obscures a lot of stuff. So I don't necessarily know, like, is this because home prices are high? Is it because mortgage rates are ticking up? Like, is it because there's remote work and people don't want to buy? Like, I'm not quite sure what really goes into this. But I think it is telling to see that sort of marked drop post-pandemic to where we are now. I mean, that's a really sharp drop. And I get that there's a ton of variables going on, so it's probably difficult to pinpoint any specific reason. But it does speak to a new mindset, a sort of a more of a rental mindset.
Well, it looks like it's been doing, both of these trends have been like 10 years in the works. Like, it looks like they're both very mature. If you go back 10 years back to 2015, they've both been going in their direction. And it looks like both of them are turning the corner at the same time, which would be a contrarian buy signal. You know what I'm saying? If I saw a stock go down,
I mean, it did get, it looks like got a little too low and it's starting to rebound. So I'm hoping that's the
both
thing.
of them, like both of them are starting to kind of go the other way. So it's interesting to see whether or not that's going to happen. And meantime, I learned something today that I had absolutely no idea, because I'm so thinking about, A, Manhattan, but B, it's like, I don't know, for some things, some data sets, I like in my head, I don't question for an update. Like, one of those things is, to give you an example, is like, what is the median time in years that somebody owns a home? And I just revert back to whatever it was in 2006 and 5, like 7 years, right? Which is what it was back in the day. Look at the left, 6.5, 6. Look at the median homeowner tenure now. When the hell did this happen? Like, I kind of, it makes sense. With 0%
slowly, then suddenly, right? It's like every year just ticking higher, ticking higher, ticking higher. Why is that? I don't know, but I feel the same way. When I saw this chart, I was like, it's not 7.
But it's 12. So like, if I wonder how many people I would have asked out there, what's the median? And they would have said 7, or they would have told me 12. And if I mean, do you find yourself tripping back all the way back? Like, how come I never asked myself to update this kind of a chart in my head? 12.
I know. There's some assumptions that are diehard. This is one of them. Is my brain. It's like 7 years.
Yeah, rock solid.
Everyone knows that.
Forever. Humans. What's the matter with us? But anyway, with everything that's going on, this is one reason why, again, structurally, guys. I know that I say this over and over again. I apologize, but like, the housing market is not where a bubble is going to bust. It will for some markets. It most likely will be outside of Manhattan. It'll be markets that are up a lot in the last 10 years. I mean, if you're up 100% in the last 10 years, the chances of you correcting are much higher. We're, of course, flat in the last 10 years. But stuff like this. Yeah.
I just want to say, just to understand, just make sure people understand what this is. This is the amount of time you live in a home before you sell it. So you buy it, and usually you live 7 years, as I thought it was always 7 years, and then you sell it again. So tenure meaning like how long are you in that home? And it's been rising. And I think what's that last value there? It's basically 12 years.
11.8.
12 years later on the median, you sell it. So it's a lot longer. It's almost double. I mean,
people are living in their homes. They're not
double, but they're living longer
out as quickly. Yeah. And you think about that, you need more inventory going on. It's structurally, the housing market is just not going to see what it saw. Everyone just reverts back to 6 and 7 and 8, the great financial crisis. Oh, it's going to happen again.
But I'm thinking, if you see some of these homes that now I'm going to put Manhattan and Brooklyn aside, and I'm going to talk about the markets. Look, I grew up in Texas, so I can speak to, suburbia and sprawl and rural. Some of these houses are ridiculous. They are, you buy a house and it's got, it's 6,000 square feet and 8 bedrooms. So you might not need to buy another house for a good 20 years because it's one of these intergenerational homes. It's got 5 different suites and, pool and a court and all that stuff. They can get crazy. I think our market's different because you buy what you can afford and what you need at the same time. So maybe you buy a 2-bedroom because you got a family coming, then a little later you need a 3-bedroom. So I can understand how Manhattan's probably the 10 years a little bit lower, but I think we're going to have to dig in because that's an interesting.
How do we find out that data? I don't even know how we'd find that out. I don't know.
We have ways.
Oh, whatever. We don't have to talk about that here. Interesting stat nonetheless. All right, I want to go back to Manhattan. Let's circle back to Manhattan now for the end of the program here, guys. You made it through the macro portion of the program. I just want to talk one more time about the return of the commercial market, guys. The return of the commercial market. John, you were at the Real Deal event. I think, was it Marianne Teague? Was that who it was? I was up on stage saying, I know.
And I feel bad because I missed it because I saw them announce that. I'm like, how did I miss this? I was there. Like, this is such a great conversation. I wish I was.
There's a lot of commercial elements going on in the Real Deal.
In the room.
From what I understand, a lot of people are seeing it. They're experiencing it. They're seeing it. It's happening. Commercial sector starring. It's going into another gear, guys. It's going into another gear. And here's some stats from CBRE.
CBRE.
Monthly leasing activity total 2.47 million square feet, propelling year-to-date activity 46% ahead. I don't like year-to-date, but if you look at the quick facts, okay, the first one, leasing activity totaled that in April, 45% ahead of the 5-year monthly average. 45% ahead. Year-to-date leasing is up 46% from the prior year. So these are some good numbers, guys. And, once this beast gets going, it's like a Titanic. It really is. And this could be a strong leading indicator. The sales market, you got the rental market, you got the commercial market. That's the pure stuff. Then you get the sales market, right? And they all operate in different frequencies, so to speak. I don't know how else to explain it. And this commercial sector and the rental market, you start looking at what's going on there, it could portend what's ultimately going to trickle down to the sales market. Okay. And I feel like we're in one of those situations right now where the rental market and the commercial market are starting to go up to another level. It's going to be really interesting, John.
What's the frequency, Kenneth?
I don't know. I couldn't think of another word to describe it. What do you think, though?
I agree. No, I'm really excited to see the return of the New York City commercial market. It's been down for a while. It's not back, but it's picking up. And you look at the average asking rent, $77 square foot. It's obviously higher for some buildings. It's lower for some buildings, some areas, et cetera. But that's a good number. It's a good number, and it's recovering. So again, when I talk about real estate, there's so many variables that go into it, and this is one of those variables. Like, do people have jobs? Do people have offices? The fact that the office market's growing, hopefully we're bringing people in, right? The city sort of thrives on its demographics, and this is a positive step, a positive sign for New York City's demographics.
Yeah, and this is like almost 2 years in the works now. I mean, when was it that they kind of, ordered back to work, right? It's like it was 12 to 24 months ago or something. I think Jamie Dimon kind of started it in the banking sector.
You think about 2020, 2021, there was serious talk about death spiral for cities. Cities are in these death spirals. So I'm hoping we're past that talk. I'm hoping we're talking about growth spirals now, but it was it was pretty spooky at the bottom.
Yeah, it was. Let me just make this a little bigger here for you guys. And you know what? We're working on different types of charts for you guys. This is a rental chart showing you some median rental numbers from April. You take a look at all the April new listing activity that came on in some of these bigger markets. What is the median asking rent? That's what this is. I'm going to try to make some charts a little prettier for you guys. We're working on this. Is a very early stage. I just wanted to give you a little sneak peek of what we're coming out with here. I mean, there's so many charts that we could make. We have so many ideas, and we're going to go into another level and start to do this kind of stuff so you guys could share this with your clients. But the reason I brought that up with you is because, again, the rental market and the commercial market, and then to tie it all back in, this dude right here, okay, Thursday, 1 o'clock. Okay, we're going to talk about why the New York City investment thesis might be coming back into focus. This will be a really interesting conversation. Noam's going to take a timeline approach to this and talk about kind of how we got here, and we'll summarize it all. It may not make sense in the beginning, but once you get to the end, we'll tie it all together. Try to make this, guys. Try to make this, because I think it's going to give you some bullet point talking points to talk to investors or buyers or anyone that looks at the investment market in New York City, or maybe you're a sales guy and just want to buy something and you're curious about that sector. I don't know. Interesting times, and we'll talk about it.
Yeah. I just have one more point on the rental sector, because I think it's really interesting, and it kind of ties into Noam's talk. So one of the things we tracked, and I don't know if we have a chart on that, but we looked at the amount of rentals, sort of just kind of deep dive on rentals in Manhattan, asking over $20,000 a month, right? Kind of the top end of the luxury stock, goes even crazier from there. This year, we've already seen over 300 deals signed with asking rents above $20,000. That compares to far more than have been. This is from basically January 1st to the end of April. So far more than we've seen in previous years. So there's definitely a push in the rental market. You're seeing it not only in that luxury sector, but as we talked about, I think last week we talked about how the rental market kind of pushed through that glass ceiling of 4,500 and is ratcheting up 4,800. I don't know what May's going to bring, but I mean, look, May, June, July, these are some of the busier rental months, and demand leads supply. So the rental market is on fire and pushing higher. And that leads to me to think that the sales market could follow.
Yeah. And that's why, let me make this a little smaller. Exactly. And that's why we're looking at this kind of stuff and telling you guys this now, because it looks like these markets are going into another gear, and once it gets going, it's gotta find its new equilibrium place, wherever that is. It could go step. Usually these things, they just shift. And it happens really quick, and then it finds its new level, and then it hangs out there for a while, and then it does its little cycles in that new level.
And again, especially with this background of this healthier commercial market, right? So you have offices and firms anchoring themselves in Midtown, downtown Brooklyn, right? You've got places where people have to be during the week, right? That pushes the rental market higher, pushes the sales market higher. So it does all,
And the sales market is the last. The sales market is the last one that's going to benefit. Guys, the sales market is the last one. I don't know if this is the year for the sales market. This is a little recovery year, right? This is all happening, by the way, when the sales market listing climate cooled. Let's just be very clear. So we're talking bullish on the rental market, the commercial market, but the sales market is in a slightly worse position today than it was in March. Still okay. Still better than the volume trap, but we're definitely cooling. I think the sales market is going to be the tertiary benefactor of this whole thing that's going on. It might take a little time. But what is the sales market going to look like? What is it going to look like when we get to that point in a year or two? That's what's going to be so interesting. That's why you want to hear what this guy has to say. It's a fascinating discussion. And I hope you guys will, engage us, because we're not going to be really sharing a lot of charts. We're going to be looking at your commentary and interjecting when possible to ask Noam questions.
So I will say that. So I think both Noah, you and I are somewhat bullish on the New York City housing market, the sales market, I should say. And we do think that, in the back of our minds, we do think this market's kind of ripe for a pop. I don't know when it's going to be, but I like your point about saying that this is kind of a recovery year, right? We started that recovery last fall. It had some hiccups this spring, but we're sort of on that trajectory. So it's an interesting thing to think about. The nice thing about real estate data is, it doesn't it does change on a dime from time to time, but generally speaking, it doesn't necessarily stop on that dime. So it takes a long time for these trends to shift. And I think we're sort of on the upswing of an interesting trend, which I think is a great way to me to segue to say, I mean, if you're out there farming, building, talking to clients, like this is the long game. A lot of this communication we're talking about now is going to pay off maybe in the fall, maybe even next spring. But it's interesting to start having some of these conversations now, I think.
Yeah. Noam thinks we're right here between 2011 and 2012 kind of thing. This is where he feels like we are. And the sales market's going to do this type of thing starting in a year or so from now. Like we still have time. Yeah. Like it didn't do anything for a little while. Then it kicked into high gear. Look at this is why I think what you just said is right. Look at this, guys. This market has done nothing in a decade, and I feel like it's undervalued. I feel like it's suppressed, and I feel like there's tentacles of our market. We talked about being at capacity. Remember the pandemic? We're at half capacity. We got to get this market. The rental market has to come back. The multifamily market has to come back. Well, we're starting to get the investors potentially coming back. We're starting to get the commercial sector back. The rental market's going to another place. We're getting closer and closer as time goes on to full capacity. And that's what's going to potentially, I think, shift us to another level. And then we'll just hang out at another level for a while. Just kind of like how we shifted up to here and then we hung out here for a while.
Yeah, it seems to be the pattern, right? Sideways, staircase up, sideways, staircase up. So it really seems like we're ending the sideways. We're about to make that staircase up. So yeah, I hope that's the case. I hope the buyers follow. I hope the sellers are happy.
Hey, listen, guys, all you need to do is just beyond your game and the market expertise thing. And, the markets will do their thing. Market does what the market wants when the market wants to do it. You just need to be aware of it. Let the clients know what's happening. I think we're done here, John. You see any questions in there? Otherwise, we'll wrap this up.
No, I think we are all good. Thank you, everybody, for joining us. And I hope to see you guys all hopefully tomorrow when we talk about contents and strategies for marketing. And then, of course, on Thursday. That's going to be a really interesting conversation.
Thanks, guys. Thank you, John Walkup. Thank you, everybody. We'll catch you guys next time. Cheers.
Bye-bye.